Dave and I hope you're having a great day, and thanks for opening up this month's video.
Today, Harry and I are going to talk to you about a subject that most people want to tend to avoid. Life insurance can understandably be a touchy subject as it involves acknowledging one's own mortality, and thinking about one's own death is not something that anyone wants to spend too much time on. However, life insurance is a critically important part of most people's financial plans, and it is something that we all should take some time to think about.
Life insurance is useful for various financial situations. For instance, starting a family. Rates will be cheaper now than when you get older. If you're planning to have a family, your future children will depend on your income. Not a bad idea to lock in your insurability now because you never know what your health will be like when you need insurance a few years down the road. Could buy a small policy now and include a rider on your policy so you have the option to add more insurance with no further medical testing later.
With established families, your children and spouse depend on your income, and so plain and simply, you need life insurance. The right amount of insurance is different for everyone depending on their income and how old their dependent children are. A good rule of thumb is to get enough insurance to pay off your debts and replace 60% of your gross income until when you would otherwise have retired. Life insurance is important not only for the spouse or working partner. Stay-at-home parents working in the home need life insurance too. The cost to hire someone to do household chores, get kids to and from school and activities, among other things, can be significant.
If you have a mortgage on your home, you should consider life insurance. A life insurance policy could ensure your surviving spouse, children, or other family could inherit the home without having to secure financing or become subject to less favorable terms. If you have life insurance on your mortgage through your bank that gave you the loan, it's a risky situation. If you want to change lenders when your term is up, which happens frequently, your life insurance is at risk every time you change banks. No guarantee the new bank will offer you coverage depending on your health status. Also, mortgage life insurance is often more expensive compared to getting your own private policy. As you pay down your mortgage, your life insurance premium stays the same, but your benefit is effectively being reduced. With private policy, your premium stays the same and so does your benefit. Plus, your family controls how they choose to use the life insurance proceeds if you die.
For people who have life insurance through work, it's not strategically sound to leave your life insurance at the hands of your employer. If you lose your job or if you choose to take another job, you will lose your insurance coverage. And there is no guarantee your next employer will offer coverage or that you will qualify for it medically at that point. If this is your only life insurance, you should consider getting your own policy.
If you own a business with partners, you should have a formal partnership agreement in place. The partnership agreement should address what would happen if one of the partners dies or becomes disabled. Life insurance can help address fairly compensating the deceased partner's surviving family and help avoid any interruptions in the business for the surviving business partners. Even sole owners may need life insurance. Your family may need to hire extra employees in the event of your death to keep the business profitable until they're able to sell it or they embark on running it themselves.
Life insurance can also be used as a tax-advantaged way to build wealth. For high net worth individuals or business owners looking to maximize their estate, life insurance can play a valuable role. People with large non-registered investment accounts who won't spend all their money during their lifetime could look at buying a life insurance policy to tax shelter some of this money that will otherwise grow with tax. Business owners of Canadian-controlled private corporations may consider life insurance as a tax shelter. Effective 2018, CCPCs have a $50,000 threshold for annual passive income, and if passive income exceeds that limit, the business will begin to lose their access to the $500,000 small business deduction limit. Permanent life insurance can tax shelter some of the assets inside of a corporation and help to avoid the negative implications of too much passive income in a privately owned corporation.
Life insurance is an excellent way to pay estate taxes. Some assets could have a large tax bill owing upon death. You may wish your heirs to be able to retain these assets and not be forced to into a sale. Common examples are family cottages, investment properties, businesses, or even art. If the estate does not have cash to cover the tax, the beneficiaries must pay the tax personally.
As you can see, there are many scenarios where life insurance is a useful tool to address your financial needs. The right life insurance policy for you will depend on a host of factors. Number one being, why do you want the insurance? Do you need to protect your family and replace your income if you die? Do you want to build your wealth and leave a bigger estate? Or do you want to protect the sweat equity you've put into your business for your family's benefit? Your financial situation may also dictate what insurance is right for you. How is your cash flow? What is your net worth? How secure is your employment status? The life stage you are in is also a good indicator of what insurance product will suit you best. Finally, how old you are and your health status are important factors as well.
David and I know life insurance can be complicated and there are lots of different options for you.
If you'd like to get together with Harry and I and review your financial plan and your insurance needs, we'd be happy to sit down with you.
Have a nice day.